and why you're here.
Sure. I'm David Siffrey. Wouldn't you say, though, that this is actually a validation or a vindication of efficient market theory? Because essentially what it's saying is individual companies may not be doing very well, or their asset return is returning less and less, more towards, say, a safer return, but that the market overall is doing quite well, right? Well, competitive pressure is growing, but wouldn't that validate that the market is just becoming more efficient?
Well, it certainly validates the market's becoming more efficient, and some of the metrics, other metrics that we look at, we don't just look at how our company is doing, we look at how our customers doing, for example, and customers are benefiting from this intensifying competition. All of us in one part of our lives are benefiting enormously. We're getting much more value at lower price. So that's great news as customers. Now, the other constituency that's benefiting from this, another metric of ours, focuses on a category of the workforce that we call creative talent. And here we draw heavily on some of the work that Richard Florida has done on different job categories that tend to emphasize creativity as part of the work component. It basically translates to knowledge workers, if you want to be simple about it. But that if you look at the creative talent in the workforce, their total cash compensation has been going significantly up over this time period. So they've been benefiting. Now, at the same time, the rest of the workforce has not been benefiting in this way. So the gap between creative talent and the rest of the workforce has been growing significantly over time. So you're absolutely right. In some cases, as customers, and if we're part of the creative talent, we are benefiting from all of these forces at work. But another way of framing it is companies are kind of caught in a pincer movement between two increasingly powerful constituencies. Customers, on the one hand, pulling margin out of the business, creative talent capturing more and more of the value add that's been created, companies squeezed in the middle. If you're a shareholder and an owner of a company, that's not great news. And I would say that in macroeconomic terms, what you would expect to see over time is reasonably consistent performance over time on return on assets. Now, if all things are held equal, you will see this movement down to a kind of equilibrium return. Yeah, but all things are not equal, and you would expect that innovation continuing throughout this period of time would lead to a fairly stable return on assets for all companies. If you put all companies together, if you assume that there's a lot of innovation going on, yes, some companies will be going down, but others will be going up, and you see this steady state. We're not seeing that. So even with all the innovation that's going on, we're seeing a dramatic and sustained over decades deterioration in return on assets.
So why don't we let John finish the story? We got a lot of questions that we want to get to. Why don't we let you finish the story, and then we'll sort of let all of you out of your time.
It's fairly close. The only other
let loose the hounds.
Introduce in this was the third element in our shift index is what we call the flow index, and that basically reflects our view that the key enabler or the key connector between these foundations and what they're doing to the economy and the performance we're seeing out here is knowledge flow. And basically, at one level, these digital infrastructures, public policy movements towards economic liberalization are creating dramatic flourishing knowledge flow. Now, at one level, that's terrible news because it means that knowledge travels much more readily across the economy. Anything that you do that's innovative gets transferred out pretty quickly. So if, at one level, this is part of the intensifying competition. One of the ways competition is intensifying is these knowledge flows are increasing. Now, on the other side, the good news part of it, if we can figure it out, is these same knowledge flows provide us all with an opportunity to learn faster and improve our performance at a much more rapid rate. But the basic message we take from the analysis we've done is companies, institutions in general, and particularly public companies, have not figured out how to take advantage of these knowledge flows to drive performance to more acceptable levels. In fact, they're facing the brunt of the attack as opposed to going on the offensive themselves with these knowledge flows. So that's the critical kind of balance between a good news, bad news story. Right now, it's largely a bad news story for companies. again, good news for the rest of us. But basically, our view is that, again, the institutional architectures that we have, the management practices that we have, are not effectively harnessing these knowledge flows in ways that can drive corporate performance. So, so that's really the challenge we put up for people. We had two primary objectives in doing the Shift Index. One was to basically create a red flag for policymakers and for executives to say, you know, you can challenge these numbers all you want, we hope you do, but at the end of the day, we're confident the basic trend line holds. It is not a good story. What are you going to do about it? What are you going to change in order to get this performance to come back? And then secondly, what we're hoping to do is just be a catalyst for a lot of discussion, like we're hopefully going to have this evening, and also for further research and analysis. This is just the tip of the iceberg in terms of the kind of analysis that can be done with the work we've started. Just to quickly highlight, one of the things we're going to do in the fall, in November, we're releasing a sequel to the Shift Index. By the way, we're going to make the Shift Index an annual event, so we're going to keep score for a while and just see if things do change. But in November, we're going to release a Shift Index that takes it down to the industry level in the U.S. economy. So we have data for 15 different industries. We can start to do comparisons between the tech industry, financial services, and healthcare, et cetera. So that will be an interesting take on this. The other direction we want to take this is globally. We've gotten a lot of interest to say, well, this is interesting to the U.S. What's going on in Germany? What's going on in the U.K.? How about China? How about India? And those are really interesting questions, and we hope to have some answers over time. This is just a start.
Kind of wrap up spin on it. In some sense, obviously, you see it emphasized in 20th century firms became preoccupied with managing stocks, intellectual assets. All they really wanted to do is preserve them, get the most out of them, squeeze them to the extreme, and then look at how do you get scalable efficiency in terms of utilizing those stocks. What we're really saying is that the shift to the 20th and 21st century, because of this infrastructure, is a movement away from the alpha channeler and motion of the firm to something that is built to basically preserve assets, protect assets, and to be able to get scalable efficiency to something we've never seen before. And that has to do with how do you actually, in this world of flow, participation in different types of flows, how do you move from scalable efficiency, which all our organizations are very often, to scalable learning. So how do you move ways to use participation in flows so that you actually can get a sense of learning within the firm, across the ecosystem, and so on and so forth. If this is right, then very few of the architectures of our firm are currently structured.
Okay. All right. Well, I was going to ask these guys a bunch of questions, but I would much rather hear from you. So I think Shannon, you have the mic. Okay, just where you are, where you're from.
So my name is Shannon Clark. I have a question that's kind of an underpinning question. I'm curious if you looked at whether assets and the definitions of them and the way we account for them and measure them have also changed in that timeline. I mean, the recent financial crisis sort of illustrated very painfully that a lot of assets that were theoretically on books really weren't on those books in an accurate reflection. And I think it strikes me that some of this downward trend may be reflective of underlying trends in what we call an asset, how we measure it, how we value it, how long we value it for. And so I'm wondering if you looked at some of those changes, they may explain some of the downward trend.
One of the benefits of being part of an account